Now here is Ticky Fullerton on Your Money.
Yes, hello there, I'm Ticky Fullerton, every night bringing you a full hour of the very best in business coverage across the nation and internationally, especially where business and politics meet. Coming up, shaky day on the market delivers a technical correction for the ASX with the PEXA float now in question and stocks hammered as investors head to AGMs for JB Hi-Fi, Blackmores and Fortescue. Top analysis from the data room, Scott Murdoch on PEXA and Junbei Liu from Tribeca Investment Partners on the rest of the market. Government banking on support from the states at tomorrow's COAG meeting for its big stick measures on energy. It's a market that's been described as anarchy in the last fortnight. So what does Labour's shadow climate change and energy minister have to say about it all? Our interview with Mark Butler just ahead. And the growing calls to do more about climate change, from the wash-up at Wentworth all the way to the boardrooms of Australia. Institute of Company Director Chief Angus Armour tells us why emissions is the new challenge for boards. Well, news for anyone interested in the fate of AMP today. The company that has probably been impacted the most from the Royal Commission fallout, and it ain't over yet. Shares fell 24% today as investors fretted about the loss of business to date and just what's in store. That said, veteran insurance executive Mike Wilkins, the acting CEO who stepped down from the board and into the brink after Craig Mellor departed, is doing his best to de-risk the ship. Today he announced a couple of deals that will set up the business ahead of the arrival of the new CEO, Mr De Ferrari, coming over from Credit Suisse. Now, give him a bit of a war chest to react to whatever else that Kenneth Hayne might throw at him following the revelations of those fee-for-no-service issues and allegations of misleading the regulator. Well, what I think these deals show is that it hasn't been an easy job to execute. Firstly, there's the AMP Life Insurance division, which is being sold to global giant Resolution Life in a $3.3 billion deal, but only $1.9 billion of that is cash. The rest is preference shares in AMP Capital and also shares in Resolution that will be monetised, presumably, when it can be. Secondly, there's the New Zealand Wealth Management and Advice business, which is planned to float off, markets permitting, and just think about today, sometime next year. Well, one wonders what David Murray, the man who's taken on the job of guiding AMP through these troubled times as chair, expects from the Royal Commission. The father of vertical integration because of how he built up Commonwealth Bank as CEO and then defender of it, having chaired the Financial Systems Inquiry, is now overseeing a sell-down to a simpler, more agile business, something I think he now accepts. But we're hearing that across all the big banks, aren't we? The downside scenario at AMP would be completely blow up its business model around platforms and advice, and it's been hinted at in the interim report from the Royal Commissioner. It's hard to imagine things could be that dark, isn't it? But perhaps that risk is also why AMP shares were at record low levels today, down, as I say, 24% to just $2.50. Well, look, in other news today, the long-awaited Property Exchange Australia float looks to be called off. The raising, planned for November 19, seems to be swept up in the recent mass of market volatility, with the Board of Directors meeting today to consider the company's options. For more on that, I'm joined by the Australian's Scott Murdoch. Scott, tell us first about PEXA.
Yeah, exactly, Ticky.
Is it called or not?
Well, that definitely does seem to be the case. There's a statement due to come out from the market pretty soon. But
I love it how you always have your phone there.
I know, I'm just waiting for a WhatsApp message, actually. So what we do know is that it seems that they couldn't get the orders to fill the book today. We know that it had been looking to raise about $750 million to $800 million. They were open yesterday. It was due to close by 11 today. It's quite a big amount. It is a big amount, and there's a couple of factors, I think, behind the reason why they haven't seemingly been able to get there. And of course, the first one is the market movements. Trying to do a capital raising like this on a day like today was always going to be, incredibly hard. But they were midway through it, so they kind of, had to press on with it. The second thing is, too, people have been saying, if you look at the way the deal's been done quite recently, they knocked back a bid by their biggest shareholder, Link, for $1.6 billion. They then said the company was worth 1.8 to 2.1. Then you had Link come out and say, well, we're going to sell half of our shares. So a lot of prospective shareholders went, well, hang on, if they're selling out because they think this is as good as it gets, what's the incentive for us to buy into it? So I think when you combine those factors plus with the market volatility today, it hasn't got there. So the question is, what happens now?
Yeah, okay, well, what happens now?
What happens now? Well, the two options which have been put to me is one that they take the float off the table, look to do it next year.
Yes.
The second one is perhaps Link's bid is a live option.
It's back on the table.
It's back on the table. It's still got a couple of days to go to expire, so it's still live.
Oh, really?
So the expectation is that that could be being considered now. I know the Link director is not at that board meeting right now. John Hawkins, he's the CFO of Link. He sits on the board of PEXA. So you can assume from that there is consideration to that. Now, whether they do decide to take this, it's going to be interesting. But also, too, PEXA has a lot of vendors in there. I think if you go through the states and the retail banks and Macquarie and Link and Paul Little, what's that, about 8 or 9? So to get to a consensus, it's got to be pretty hard.
Yeah. Well, but they obviously need the money. They want the money to grow.
Well,
so
they do. The company does. But also, too, if you have a look at it, only $80 million of that proceeds is going back to the company. So that's the growth. The shareholders want to get out. Plus, also, like I said, there are so many different vendors in there. You've got the state governments who mostly want to sell. You've got the Victorian government who wants to keep a bit. You've got Commonwealth Bank who wants to own it. The retail banks don't want the Commonwealth Bank owning it. So, it's a really tough situation to navigate.
Okay, another tough situation to navigate, AMP. I didn't actually talk about the outflows and the industry funds, because the outflows have been actually massive during this quarter, haven't they, compared to just the June quarter?
Yeah, so there was not only the transaction news today, there was that update which showed there had been big flows out of it, and I was just on the phone before I came down, and one advisor was saying he thinks that's a big reason for the fall today, like 24%. It's a little bit irrational, just on the back of, again, you've got to put it in the context of the market today, but for the stock to fall that much just on the back of the transaction, he's saying, that doesn't really line up all that much. So,
well, a quarter of the value of the business is gone. Yeah,
exactly right, in one session. So, but as you mentioned in your introduction, there's a lot of questions around the way this has been, the shape of the transaction. It's, 1.9 billion, I think it was, versus 3.3 is the headline. There's a lot of kind of almost drag along. AMP is still exposed to this business.
What about its register?
Well, there is talk this afternoon that Perpetual has sold out. They started selling down their stock in April. So the question is...
Talk that they've sold out altogether?
Yeah, so they've only got about 1.5 million shares left. It's only quite small, but they have been selling since really before AMP got dragged through the Royal Commission. So when you've got major shareholders liquidating their stock like that today, that goes to show that David Murray and also the new CEO have got to rebuild trust in that company. And that's, is going to be a very big task for them to do. Yeah,
and you've got this sort of almost overhang before the Royal Commission.
Well, exactly, and there's questions, what else could come from the Royal Commission? Okay, they're going to sell, float this business in New Zealand. Are they going to be able to do it? Wealth management businesses are on the nose. Are there other bits of the business which they may need to get rid of? The AMP Bank, it's only small, but people say it does quite well. Is that going to come onto the market? Like, the future, is AMP just going to be AMP Capital? So.
All right, listen, I must ask you, there's another boardroom meeting going on today. HealthScope, which we've been following very carefully. Now, Paula Dwyer, the chair there, is under quite a lot of pressure, isn't she?
Yeah, she is. So they're in a board meeting right now. There's some expectation we could get an announcement tomorrow as to whether they're going to allow due diligence. Of course, last time when BETH was here in April, they took 4 weeks.
These are the private equity guys, Ben Gray.
Ben Gray. So it took 4 weeks for them last time to reject the bid. The expectation is that with the stock having traded where it was before this bid, so I think on Monday the stock closed at $1.78.5. Now you compare that to $2.36 in terms of the company is already.
That's the same price they went with earlier.
Yeah, it was, and their justification has been while the profit outlook for the company is pretty bad, they've had an earnings downgrade. You've got, and I wrote about this today, you've got a Labor government coming in. They're going to cap health insurance premiums. They're saying, well, it's really an increase, but on the table it's still $2.36. You'd have to think with such a big difference at $1.78 to $2.36 that it would be pretty compelling at least to open the book. So we think
exactly,
and also,
and then you've got this extraordinary situation with Aussie Super with what 14% or whatever.
Yeah, so they're locked up
with the private equity guys.
Yeah,
and you've got Ashok Jacob there with Elliston, who quite wants to sell.
Yeah, exactly. So they haven't joined the bid financially, but they're saying we back the bid. Yeah. It's going to be really difficult, and they're going to have to justify it to come out and say, no, we're not even engaging. I think. And
they've got the AGM.
That's next week. They're facing a strike then. Paula Dwyer's on track to get a second strike. It's it's going to be interesting to see.
Scott Murdoch, full of information. Thank you so much. Great to talk.
Thanks, Ticky.
OK, well, look, switching to politics now. It's been very busy there as well. The job of government got a whole lot harder for the Prime Minister after last week's by-election, not just because he's now dealing with a hung Parliament. A big message coming from that electorate is unlikely to be brewing in a few other Liberal electorates with reasonably comfortable margins, is that the government needs to listen more about climate change. Now, having ditched the NEG under pressure from its far-right flank, Energy Minister Angus Taylor, well, of course, that was Josh Frydenberg as Energy Minister, but the new Energy Minister, Angus Taylor, has re-emerged with half of the NEG, this reliability mechanism, and a plan for a default reference price for retail electricity. He's waving around a big stick as he takes these and other measures to COAG tomorrow for approval. Well, the horror of businesses like AGL and Origin, the Energy Minister has also summoned them to a round table where they will commit, if you please, to lower prices before the default comes in. Angus Taylor's letter said, "I write seeking your undertaking that sizable reductions in current standing offers for your electricity customers are in place effective 1 January 2019. Remember, there's an election coming. The thinking is that, above all in this pre-election period, that voters care about down electricity prices and keeping the lights on. But voters are fickle and have short memories, and many of them I don't think will remember, and some of them were unaffected anyway by power cuts. Instead, in key seats, all this pro-coal talk at a time when another IPCC report is released has sparked a new momentum on emissions concerns. And while the Prime Minister insists that we'll always have Paris and will achieve the government's 26% emissions reduction in a canter, that appears not to be enough for the worried wealthy in Wentworth, and perhaps a broader audience too, including boards of directors. We'll talk about that a little bit later. Into all of this, federal Labor is banging on again about the NEG. So, if it returned to government by May, say, next year or earlier, would it put the NEG back on the table? I spoke with Shadow Minister for Climate Change and Energy, Mark Butler. Mark Butler, great to talk to you there. Now, is the government right to prioritise electricity prices for hard-working Australians over absolutely everything else, including climate change?
Well, we're obviously all very concerned about the price rises that we've seen over the last several years, particularly as the energy crisis in the eastern states has bitten so hard on businesses and households. We've seen power prices go up and up and up, and obviously we're all very focused on doing everything we can to bring them down. But I think it's a sense of a false choice that reducing emissions is inconsistent with reducing power prices, when actually what we know from evidence here in Australia and all around the world is that the cheapest way to build new power is to put renewables into the system. We know that through our experience right now. The only reason wholesale power prices were coming down over the last 12 or 18 months is the very big build in cheap renewables we've seen to discharge the renewable energy target. Through Senate estimates processes over the course of this week, the government's own departments have admitted that. So it's a false choice. What we obviously need to do is get power prices down. They're really crippling household and business budgets. Yes. But we also do need to get carbon emissions down, and we can do both at the same time by expanding renewable energy.
One of the problems, though, with this has been, I mean, we've had the Energy Security Board chair describing the market out there as anarchy. And one of the problems of the amount of renewable energy that is being thrown into the grid at the moment, as you know, is it's not stable, and it's the issue of transition that is so tricky for any government of the day to manage. Everybody wants to move to renewables, but we've got this problem with dispatchability, and it is going to be quite costly, the government argues, if you push the amount of renewables and continue to push the amount into the grid that Labor would like to do so.
Well, not everyone wants to move to renewables. The government certainly does not want to expand renewable energy. They've made that very clear, particularly with the new Energy Minister, who's really built his career on campaigning against renewable energy.
Well, he says there's enough there already. Right. It's going gangbusters, renewables, as we know, both at the household level and indeed in corporate land.
And I expect household renewables will continue to expand fast, particularly as power prices stay high, as they will if this government's not able to get energy policy under control. But you will see investment in large-scale renewable energy really start to slow very significantly as the renewable energy target investment period comes to an end over the next 12 months or so. But you're right, obviously a grid that's based on more renewable energy than historically we've been used to is going to need firming up technology. We are going to have to see investment in pumped hydro, some of the new battery technology, a much cleverer response to demand response, so really being careful about energy use at the peak periods. But you do see that through the market operators' work happening already. You do see that through different business approaches to their energy use at peak times to reduce their bills at those peak times.
But isn't
I'm very confident, as you see around...
Yeah, isn't this what the government is trying to do, though? What Angus Taylor is trying to do in terms of delivering firmed up power, and indeed he's going to COAG tomorrow to ask for approval to do exactly that and to get some of these projects actually underwritten by the government.
No, that's what the National Energy Guarantee was intending to do. For the first time, it was going to bring emissions policy, which will underwrite or underpin almost all of the new investment in a system that shifts to renewables, with the reliability obligation that the Security or the Energy Security Board had been working on for so long. This was really the holy grail we'd been working towards for such a long period of time. The states, business organisations, federal Labor, and frankly Malcolm Turnbull and Josh Frydenberg as well. And we almost got there until Angus Taylor and Tony Abbott and others tore the last Prime Minister down based on that energy policy. So yes, Angus Taylor will take the reliability obligation to the COAG Energy Council tomorrow, but that's only half of the solution. The other half is to have an investment framework that sets the rules for energy companies that do want to build new energy. They do want to build new electricity generation, and frankly we need them to do that because we're going to start to see more and more of the older generators start to exit the system over the coming decade.
Yeah, but going back to trying to make sure there's a smooth transition, we all know what happened when Hazelwood shut too fast. It created really the basis of the problem we've got at the moment with prices. If we don't make sure that we have that firmed up power, and it may indeed, as the Energy Minister has said, include using supporting existing coal power stations to stick around as they're being hollowed out at the moment by the use of renewable energy in the grid. Would you support that? Would you support what he's taking to COAG tomorrow?
Well, we support the reliability obligation. We always have. Now, it's a matter for the states to determine whether the position that Angus Taylor puts to them tomorrow is something they can tick off then and there. I'm not quite sure what the finer details of that is, but the reliability obligation has been worked on now for quite a considerable period since Alan Finkel, the Chief Scientist, first handed down his report. The market operator's been working on it, the industry has, states and territories have as well, and I've said a number of times it would be an enormous pity if the vandalism that really the Coalition Party Room conducted against the National Energy Guarantee also saw that important reliability work interrupted as well. So I hope that does continue. Whether it gets ticked off tomorrow or not is really a matter for the states.
Well, indeed, business is looking. We've heard from those conferences that happened a couple of weeks ago that business itself seems to be looking at some sort of emissions target that they could get together. If Labor does bring back an NEG, were it to move into government, and it still has its 45% emissions reduction target, how can customers and Australian taxpayers be confident that you can manage this without either customers or taxpayers actually getting hit by the lumpy way the transition is going to eventuate?
Well, there's no doubt that there needs to be a better approach to particularly the exit of the older generators. We saw Hazelwood come out with about 5 months' notice only given to the system, but more importantly perhaps to the local community and the workers who lost their jobs. At Alinta in the Iron Triangle in South Australia, the northern power station closed with only 11 months' notice. And Alan Finkel, the Chief Scientist, made the point very strongly, we can't have such big, important parts of our electricity system exit with such short periods of notice. So we do need to try and make this transition out of a generation of electricity generators that were built in the 60s and 70s. Inevitably they're going to retire. We can't see that happen in that very chaotic way we've seen over the last several years, and it is important we continue to work on Alan Finkel's recommendation for a minimum 3-year notice period of those generators.
But who's going to,
and we focus heavily on reliability as well.
Yeah, but if you're at some stage, I mean, the market is so, you know, out of kilter that intervention of one sort or another is inevitable, even for free marketeers, I think. But are you actually going to get to a stage where you're going to be forcing companies to stay open? I mean, already the gas companies, we're seeing the price cuts that have happened as a result of intervention. Are you going to force companies to keep, say, coal-fired power stations open against business interests and shareholders' interests?
Well, I mean, that's really what the government has been playing at around the Liddell Power Station, which is almost 50 years old. I think everyone in the industry would agree is one of the clunkier power station. Well, I mean, I think their announcement about a divestment power a couple of days ago, I think if you read between the lines, it's all about the Liddell Power Station. Now AGL made it very clear that...
This is the big stick.
Well, the so-called big stick, we don't know what it's going to be used for. It wasn't a recommendation from the ACCC. It's important to point out the ACCC considered through its lengthy retail inquiry whether a divestment power should be used and would be in the interests of consumers, both business and households, and it came to the view that it would not. It did not recommend a divestment power. And if this was about consumers, the ACCC would have recommended it, and they didn't. And
Do you
Rod
support
Sims,
it?
the chair of the ACCC, no, I don't, and we've made that very clear. Rod Sims, the chair of the ACCC, said at Senate estimates earlier today that he wasn't even consulted by the government about whether or not a divestment power would be the interests of consumers, and he reiterated his view that such a power would be, in his words, an extreme step, and that his view hadn't changed, and that is that he hadn't recommended that the government pick it up. So really what you're talking about is a view in the coalition party room that says coal stations should never close. Now, AGL has said to keep Liddell open for another 5 or 7 years would cost about $900 million, which would have to be recouped over a very short period of time, and would deliver power at 25% higher prices than the portfolio of renewables and pumped hydro that they...
Yes, but sorry to interrupt you, but business is equally concerned about Labour's 45% emissions reduction target and how it will manage the transition to renewables in terms of investment certainty. There seems to be very unclear as to how you're actually going to manage such a tricky issue.
Well, up until 8 weeks ago, I think every business organisation in the country, states and territories, federal Labor and the federal government itself, was working on these issues through the prism of the National Energy Guarantee. And
so that's what you'll bring back, the NEG?
Ripped off it. Well, we've said that the government should come back to the table on the NEG. You know, we've had every business organisation out this morning calling on the government to bring emissions reduction back into energy policy. We've had the Institute of Company Directors with their regular survey.
So Mark, if you came back into government, would you bring it back on the table?
Well, we've said that the NEG was an important piece of work that business organisations, industry and the electricity agencies put a lot of work into. We thought it was a workable model, it was a scalable model. Now, at the end of the day, it only really works if there's bipartisan agreement. I mean, that was the value you got from the National Energy Guarantee or the previous iterations of policy like Alan Finkel's clean energy target. Both major parties would agree on the investment rules and give investors that level of certainty that they need to put very substantial sums of money into renewing our ageing, increasingly unreliable infrastructure. Now, if the government doesn't, the Liberal Party doesn't come back to the table on this, we do have a very serious problem with the approach of a bipartisan market mechanism.
Finally, can I just ask you about the actual price, the idea of this default price, which Angus Taylor will be taking to COAG tomorrow? Do you support it, and would you also support that default price returning into a cap if prices don't fall as the government expects they will?
Well, we were the first out to accept the recommendation in this respect from the ACCC when the report was released some months ago. I think it's more than 10 weeks ago that Bill Shorten and I accepted that recommendation that there be a default price which would effectively replace the standing offers in the system. There's a potpourri of standing offers in every market. It's very hard for consumers to work out quite what benchmarks are being used when they're considering different discounts. So we said 10 weeks ago we support it. Malcolm Turnbull and Josh Frydenberg followed suit within 24 hours. This has been a bipartisan position in energy policy now for 10 weeks. There's nothing new about what Angus Taylor and Scott Morrison announced this week.
Would you turn it into a cap if prices didn't come down?
Well, we think the recommendation that Rod Sims made about the design of this was a recommendation considered over a very lengthy inquiry, and we accept the advice of the consumer watchdog. Now, obviously, there needs to be work about designing how that default price is set, making sure there's a little bit of headroom, as Rod Sims describes it, to allow good competition in the system between retailers to the benefit of consumers. But we accept the advice of the ACCC, and we think there should be good work on implementing it.
Yeah. But does that mean a cap if it doesn't work?
Well, let's cross that bridge when we come to it. I mean, Rod Sims considered a whole range of different models.
Yes.
He after a very lengthy inquiry, recommended this. We haven't even got to the point of starting to design it.
Right.
So let's not worry about moving on to another alternative. Let's see whether the considered advice of the consumer watchdog works.
Climate Change and Energy Shadow Minister Mark Butler, thank you very much for joining us.
My pleasure.
Such an important space, isn't it? After the break, Senator Anning acts from Katter's Australian Party. More on that next from Sky News political reporter Annalise Nielsen.
You're watching Ticky on Your Money. Now, back to Ticky.
Welcome back. Switching to politics now, and Senator Fraser Anning has been dumped by the Katter Australian Party. The party releasing a statement saying 99% of what Senator Anning has been saying is solid gold. However, there is 1% of what he's saying that is totally unacceptable. Well, for more, let's bring in Sky News political reporter Annalise Nielsen, who joins me now live from Canberra. Well, it's taken a bit of a while, hasn't it?
It has, and it certainly wasn't unexpected, but it is something that's very important and going to have some pretty serious ramifications in Parliament, because Fraser Anning has been causing quite a few waves with his anti-immigration policies. In particular, he has been quite specific that he thinks we should only have European immigrants to Australia, and has spoken extensively about non-European immigrants. And it was his continued push for this plebiscite about that question that's really seen him get into strife, and he's now been dropped by the Katter Australia Party. This is now there are quite a few moves for Mr. Anning in the last few year. He was previously with Pauline Hanson's One Nation Party, and then left them and was briefly an independent before joining Mr. Katter's party. But it was Mr. Katter who said it was a unanimous decision of his party's executive that Fraser Anning couldn't keep pushing this line and stay with them.
In spite of the most severe and clear warnings, Senator Anning has continued down this pathway, and consequently we announced the termination of his endorsement by the KP. Clearly, Fraser wants the freedom to pursue his crusade, and we think it is best for he and the party to give him this freedom.
Now, some of the more sceptical minds around Parliament were saying this might have had a bit to do with those Labor preferences going towards Mr. Katter. He hasn't had the easiest time getting back into Parliament, despite being a long-term MP, but he vigorously denied that today, said that it had absolutely nothing to do with it. He couldn't continue to support anyone who was supporting what was a racist policy, he said, and it would have impact on other communities that he wants to be seeing brought into Australia, people like Sikhs, and he was concerned about the impact on the Jewish community as well.
Somebody else was creating a bit of a stir in Parliament today, Richard Di Natale from the Greens.
Yeah, that's right. It's part of his MO, I think. He's always trying to push the Greens' point, and he did very well today. But he was talking in particular about this issue that we've seen in the United States with growing tension around just between the two major parties there. We saw those pipe bombs being sent to a number of prominent Democrats today, and then also CNN headquarters evacuated. That's really quite a shocking escalation in things there. And he said that there's a lesson to be learned for Australia as well about not promoting divisive views and not promoting the differences between different people's opinions, that we should be taking a lesson there about working more collaboratively.
I don't think it's a leap, Laura. I think it's common sense. When you've got the President of the US who uses the sort of inflammatory language that he does, who basically preaches violence. I mean, he's done it at his campaign rallies. He talks about wanting to beat up journalists and protesters. This is a man who's giving licence to people on the fringes of US society, and it's no surprise that some of them feel empowered to act in this way.
And as you'd imagine, Mr Di Natale's had quite a bit to say about Fraser Anning's speeches before, so I think he'll be quite pleased by the latest development. And he'll also be pleased, just a moment ago, we had Liberal backbencher Julia Banks standing up and saying that more needs to be done on Nauru. That's quite an extraordinary turn of events to have a Coalition MP standing up and outwardly defying the Coalition's policy on that point. And so things really are heating up in the last few hours of this sitting week.
Goodness me, everyone's got an opinion. Annalise Nielsen, thank you very much indeed.
Thank you.
All right, moving to property now. And look, the slowdown in residential markets expected to continue over the next few years. And a new report out from Biz Oxford Economics for QBE, dwelling prices in the two biggest capital cities at least face more bad news as mortgage rates rise. Investors tighten their belts. According to the figures, Sydney is set to sink 3.5% next year and bottom out in 2020. Not so good for Melbourne either, falling over 4% in 2019. But better times ahead. 2021 is looking like a positive year for the overall market, with an upturn in prices expected to emerge. So what should investors and potential property buyers do? Jump in at the bottom? Who knows? For more, I'm pleased to welcome someone who might, Phil White, who's CEO of QBE LMI. Phil, great to have you here.
Thank you very much.
Now, for those that don't know, LMI, what's the business that QBE is in?
We're in the dream of making dreams come true for people who do not have a substantial deposit but want to buy a home. So you offer insurance for a deposit? We offer the banks the ability to insure the risk of a borrower defaulting on their home loan and the shortfall from the sale of the property being insufficient to cover the outstanding debt. Yes. We would then step in and pay the bank the outstanding amount. Yeah, yeah. Now, you've got a very glass half full just reading your report about the market generally. I think we've got a balanced view. We've been working with Biz Oxford Economics for 17 years producing this report. Yes. And their history is pretty good. Yeah. So, I mean, let's hit the big markets first of Sydney and Melbourne. As you're saying, the prices are coming off at the moment. They're coming down. But you think it might be a good opportunity to come in and look at buying in property now in terms of first home buyers? Absolutely. If you're a first home buyer, affordability is improving. We've got certain concessions in terms of stamp duty that have certainly invited first home buyers into the market over the last 12 months. And we think that window of opportunity remains open for about the next 12 months or so. What's actually been happening in terms of flows that you've been looking at with first home buyers? First home buyers, nationally, the lending to first home buyers has increased by about 28.4% over the last 12 months. That's extraordinary. In Sydney, it's actually increased by almost 84%. Wow. Melbourne, 36%. And this is because you think the market is coming off, and so first home buyers are actually, there's more space for them to get into the market? That's right. So as we've been putting more restrictions and more costs onto investors, both foreign and domestic, we've seen them retreating from the market. That has provided opportunities for first home buyers. But the key thing's been the stimulus really by the Victorian and New South Wales governments that really kicked off last year. And we can see a big uptick in terms of first home buyer activity. Yep. But there's pent-up demand. We haven't seen first home buyers in the market really since about 2008 when we had the stimulus post-GFC. So they've still got maybe a year, though, to get through, looking at the outlook certainly in the Sydney and Melbourne markets of slightly falling prices, don't they? That's right.
So it's a question of actually where you get in and looking at the opportunities, I suppose, around the market.
Absolutely, but fundamentally, this is a natural drive to create independent households.
Yes.
Yeah, so we've got natural population growth, we've got international migration. Those people need somewhere to live. Our population growth is still forecast to be running at, about 1.5% per annum. Population's 25 million. 7th of August this year, we hit that big milestone. By 2030, it's forecast to be about 30 million.
Yep.
That's about 2 million more homes we've got to build over the next 12 years to accommodate those people.
And what about the other parts of Australia? Because there, seemingly, the market looks reasonably healthy.
Yes, I mean, you've got a very mixed view depending on which capital city. So you've got markets like Perth, which have seen, obviously, house prices coming up for the last 3 or 4 years.
Well after the boom, yeah.
Well after the boom. They've had a period of mixed view even before that. But going forward, we're expecting to see the economy pick up a little bit in WA, and that will follow with a bit of improvement in the house price. The unit market will lag, as the unit market's going to lag everywhere, because we've just been building so much by way of high and medium density apartments.
Yep.
So our outlook for the apartment market and the unit market is, in fact, only Hobart is going to outperform the CPI over the next 3 years.
Yeah, it's looking at well supplied there. What about Brisbane and Adelaide?
Brisbane, big oversupply of units there, so we're forecasting that house prices can do pretty well. I think about 11% over the next 3 years.
Yeah.
Units not so good, probably down about 5%.
Yeah.
Adelaide, in contrast, is forecast to be the highest house price growth over the coming 3 years, and they've had steady growth. The last 5 years, they've had about 3 to 4% growth per annum. That's forecast to continue.
Slow growth in Adelaide.
Slow growth,
Slow
but it's
steady.
a great example of what strong economy, low interest rates and population growth can really do.
Well, yes, and they've got great unemployment numbers coming out of South Australia now, so that's a good thing.
Absolutely.
Now, one thing I was going to ask you is, I mean, your business model, obviously, offering insurance for people that can't afford the deposit. Have the regulators come and had a look at this at all, given the Royal Commission and everything else? How do you sit there?
Look, we've been in business since 1965. The whole of the LMI industry was established by the government to help first home buyers achieve that dream of home ownership. So we've been an integral part of the market. We haven't been changing our business model to be encouraging people who can't afford a mortgage to get one. We literally support those that can afford the mortgage, just don't have the deposit. And when you see what's happened with house prices, people are keen to get into the market early.
Yeah. Finally, do you think we've got this idea of negative gearing coming off? It's been knocking around. Should Labor get in? Is that going to affect things, do you think, if Labor gets in?
I do think negative gearing is an important consideration in this market. About 65% of investors claim some degree of negative gearing. We've been pushing investors out with increasing the cost and restricting their access to credit. If there's something else that will further dampen the demand from the investors, then we can expect to see
might that
prices
help
respond.
the first-home buyers?
And absolutely. So every time one person loses, there's an opportunity for others. So good first-home buyers, great opportunity over the next 12 months.
Right, OK. You heard it here from Phil White. Thank you very much, Phil.
Thank you very much.
OK. Now, after the break, climate change again. Climate change on the minds of our ASX 200 board directors. Angus Armour, CEO of the AICD, next.
This is Ticky on Your Money, covering the big business stories.
Yes, welcome back. Well, we're right in the middle of AGM season, of course, and more on today's meetings coming up. But in the boardrooms themselves, it's the issue of climate change that has floated to the top in director concerns. So says the peak body for boards in its Director Sentiment Index. In a survey of 1,200 directors, climate change is the number one priority that boards want the government to sort out. And what's interesting about this is that the pressure on boards is coming both from the regulator side and from their shareholders. Well, CEO of the Australian Institute of Company Directors, Angus Armour, joins me from Adelaide to unpack the index. Angus, great to see you there. Now, is it true? Is it true? Did it surprise you a lot? Because this is the first time, isn't it, that climate change has come to the very top?
It is, Ticky, and I don't think we expected that result, but it is consistent with the surveys you and I have talked about in the past. Energy policy has always been at the top of the list when it's come to policy reform for government.
So I was saying that regulators and regulation had a lot to do with this. In what ways are directors concerned about what the regulators are talking?
I think there, obviously in the context of the Royal Commission, Ticky, there's a lot of conversation in boardrooms and in industries outside banking about the responsibilities of directors and how they can be confident that they're inculcating the right culture and having the right behavior and conduct in their organizations, particularly if they're large and complex organizations. They're very focused on it, and they're concerned that they're losing the community's trust.
Yeah, and if we go down to even the sort of smaller ones within the ASX 200, I mean, presumably a lot of boards are actually doing things about climate change themselves, or the companies that they're involved with are.
That's probably right, Ticky. I have to just sort of step back for a second and say that our membership extends to NFPs and small business as well. So it's not just the listed companies that have formed this view. It's actually quite a broad community. We have 43,000 members across the entire community. So this is a community position saying climate change matters, which again is not unexpected because they've been saying energy policy matters, and they've been saying that consistently for years. Whether it's about energy security or energy prices, this has been a concern that's been weighing on them for some time.
Indeed. Now, the other side of things, of course, is the shareholders. Now, shareholders have been getting more and more active in terms of pressure on boards, but the push has very much come on climate change from them too.
Indeed, there are parts of the community that want to see very decisive action around climate change for particular industries, and that's their right. And certainly the proxy firms as well are heavily invested in this issue. But I don't want to paint the picture that it's all about climate change. I think if you look at the things that are keeping directors awake at night, again, across that broad community, it's about financial sustainability, it's about business reputation, it's about culture. They're very concerned about the global economic outlook, the threat of protectionism, and the economic uncertainty that comes along with that. So it's quite a widespread survey.
Did you get any feel for what they think of the current government and perhaps the lack of policy in many sectors at the moment, the lack of a coherent vision?
Well, I think at the highest level, Ticky, when you look at the number, 84% say the current quality of public policy debate in Australia is affecting them negatively. So that's a very, at a macro level, that's a really bad statistic, obviously. Almost 80% say the current conversations in government are affecting consumer confidence. More than half say the current government conversations are affecting their business decision making. So there is a very clear message from this broad community that we need significant and often bipartisan policy reform in order to move the economy forward.
Yeah. So in a way, we've got right within now the election campaign. It doesn't look like it's going to get any better until at least there is one side or the other with something of a mandate. I guess the concerns are expected to continue.
I think that will weigh in people's minds for some time to come, Ticky, yes.
Yeah. Anything else that strikes you about this season at the moment? I guess you mentioned the relationship between business and government, and business and the community. We've of course got the Royal Commission still in full swing. We've got another Royal Commission being kicked off in the aged care sector. Presumably this is all weighing on boards' minds.
Yes, it is. So 90% of them say we're investing in culture, we're trying to get ahead of the curve in terms of reestablishing trust with the community. They understand that they need to basically earn that trust back, to show more respect to their customers and clients, to show true leadership in what they're doing, to demonstrate that they have strong cultures that people can have confidence in will deliver the right outcomes. I think the Banking Royal Commission has revealed some pretty indefensible behaviors. We're very concerned, obviously, going into the Aged Care Commission as well.
Yeah, and obviously we're in the middle of AGM season. There are, one or two first strikes, one or two seconds that are going through. How do boards look at the current concern from both shareholders and the wider community that our payment structures for top management and indeed boards are out of whack with community expectations?
With the conversations I have with the listed directors, Ticky are absolutely aligned with the community sentiment, so they want to simplify remuneration structures. You've seen some of them speak publicly about the level of executive pay and the concerns of the community. I think the challenge we're facing right now is having consistent dialogue with the proxy investors and the institutional investors to establish a framework that the community will accept and that we can rely on for a period to come. It's the uncertainty that moves from AGM to AGM that is actually causing us some concern right now.
Yeah, well, and you can see the frustration with John Mullen at Telstra, but I'm sure it'll be a conversation that goes forward. Angus Armour, thank you very much for filling us in on all that.
Thanks, Ticky.
Now, after the break, the ASX 200 slides as volatility and disappointing US earnings weigh on global markets. More with Junbei Lee from Tribeca Investment Partners next.
Now, back to Ticky.
Welcome back. Well, zeroing in on the market now. What a dismal day for the ASX 200. The index closing down 2.8%. Stocks plunging deep into correction territory at the lowest level in over a year. 50 billion has been wiped off the local bourse as geopolitical volatility, disappointing US earnings as well, weigh on global markets. Well, for her analysis, I'm joined by Junbei Lee from Tribeca Investment Partners, live from our Sydney City studio. Junbei, thanks so much for being there. I guess some sort of correction was coming, and then we had particularly the US tech stocks do shockingly as a lead into all of this.
Absolutely. It's good to be here, Ticky. Look, yes, they always say be careful what you hope for. And we've been saying that the tech sector has been very expensive now. That has triggered the global risk-off, and which means every other sector was sold off. So what we're seeing is essentially just red across the board.
Red across the board, and you know, AMP, I can see the picture of the building behind you. AMP, what, a quarter of its value wiped today?
It was incredible. I have never seen an ASX 100 company fallen that much. Perhaps I've seen it, but just not very frequent. It's very, very rare. Now, of course, the company has said they're going to sell those traditional or slow and growing business, but of course, the multiple was half of what was expected. Investors just engage in that panic selling, thinking what is really left of that business if you sell those businesses at such low multiple.
Yeah, do you have a feel that it's a bit of overreach and that the stock will come back a bit?
Oh, look, absolutely. It still looks like it's a very difficult investment because with the multiple it's implying the current business is now trading at a multiple that is very similar to, say, the likes of IFL, and which is much better business. Don't forget, AMP still have yet to felt the impact from the Royal Commission. So, you know, and they can buy fund managers at similar sort of multiples. So still a bit too expensive at this point.
Right, Mr. De Ferrara has his work cut out for him there, I think. What other sectors were particularly hit today?
Look, we are seeing the sectors mainly to do, so the tech sectors has been very, very weak, of course, following the US lead. And of course, we're seeing also very weak sectors across the US cyclicals. So these are the companies that has earnings actually exposed to the US growth as the global growth assumption has been lowered. That is being punished quite unfairly. Think stocks such as BlueScope.
Okay, we had a couple of AGMs today. I see Fortescue came through. What does the market think of Fortescue? I think Blackmore's came through as well, and JB Hi-Fi.
That's right. It's interesting. Look, I think in terms of Fortescue, it was somewhat in line. With the JB Hi-Fi, it was interesting. They reaffirmed the guidance, and the actual like-for-like growth number doesn't look too bad, which is very surprising. Of course, the stock ended the day down, but the trading numbers look somewhat pretty good, especially for the good guys. So, so that's a good sign. Blackmore's a good sales number. Talk about investment in marketing. Still a lot of uncertainty out of China license approval, whether they can actually sell those products online into China from January next year. So still a lot of uncertainties. So the stock was sold off on the back of it.
Take you back to JB Hi-Fi for a moment. That really would seem to be bucking the trend on retail, wouldn't it, Junbei?
That's right. It's quite unusual. Look, we have a lot of supplier feedback has been saying things have been very tough. So especially across the furniture, the white goods, which is pretty much good guys. So we've seen a comp store growth. It's about 1%. So it is slowing. So of course they have a bit of a cost lever that they can pull. So we keep fingers crossed to see if they can actually get it through by the result time.
Yeah, and Blackmores, as you say, all dependent on China. Do investors worry about this constant sort of almost sovereign risk they have with exporters to China? I'm looking at the dairy side as well as Blackmores. I mean, it has been a roller coaster ride for them, hasn't it?
Yeah, that's quite incredible. Look, it's just that we are so new in the real consumer experience of those consumer products going to China. This is just how Chinese do business. They let the sector go for a run, and then they come up with regulation. And the regulation is not well thought of, and it just takes some time to implement it. So that is a problem faced by a lot of those companies. And we really need clarity of what the regulation is going to be. Then, from then on, you can rebase and invest in those businesses.
Yeah, right, so bring it on. Now look, I must ask you about the big four banks as well. How did they fare, given obviously that there's a lot of sort of index weighting considerations, one would think?
Yeah, look, today across the board, they performed pretty much in line with the market, just slightly better. When the market is selling off, going risk off, the banks doesn't look too bad at this point. It still performs somewhat in line with the market, just marginally better. As they are heading into the reporting season, there is expectation that results should, there should be enough price support because of the big dividend that's potentially to come.
Right, OK, yeah, we've got them next week and the week after, those three banks. Commonwealth Bank is always out of step, of course, but the other three coming through. Now, we've had this correction. We're down, what, 10% on the recent high. Come on, Junbei, get out that crystal ball. What do you reckon?
Let's go buy something. Look, we are hearing the reason for this sell-off is pretty much triggered by the same trend-setting, trend-following technical funds, which was the one that triggered the February sell-off. We have yet to see the retail investors pulling money out, so that's measured by the ETF outflow. That has yet to come through. So we potentially, if we have a couple of good results in the next few days or next week, potentially can have a bit of a rebound, but the retail investor money is very much dependent on where the trajectory goes. And because if they do start pulling money out, that could take another month for us to get through this.
Junbei, smart lady you are. Thank you very much. Always love your views. Thanks a lot.
Thank you.
Well, that's all for the show tonight. Tomorrow night, Amanda Lacaze, CEO of Linus from Malaysia. See you tomorrow night at 5 p.m. on Your Money, Channel 95, or on catch-up on Channel 604 at 8 p.m. Until then, thanks for your company.